Module 2, Advanced Concepts in Capital Markets and Institutions. 1. Valuation of financial assets. Valuation is at the heart of capital markets. When investors buy a bond, stock, or any other financial instrument, they are essentially paying today for the right to receive future cash flows. The main question they must answer is, what is that right worth today? Valuation is influenced by several factors. Expected cash flows. The more cash you expect to receive in the future, the more valuable the asset. Time value of money. Money today is worth more than the same amount in the future because it can be invested to earn a return. Risk. Higher risk generally requires higher potential returns to attract investors. Market interest rates. When rates rise, the present value of future cash flows falls, and vice versa. Stocks are valued differently from bonds. A stock represents ownership in a company, and its value depends on expectations of future earnings and dividends. Bonds, in contrast, are debt instruments, and their value depends on the fixed interest payments and repayment of principal. In real markets, valuation is not purely mechanical. Investor psychology, macroeconomic trends, and unexpected events, such as political instability or technological breakthroughs, can all influence asset prices. 2. Characteristics of financial instruments in money and capital markets. Financial instruments can be categorized by maturity, risk, liquidity, and purpose. Money market instruments. These are short-term securities with maturities of 1 year or less. They include treasury bills, commercial paper, certificates of deposit, repurchase agreements. They are considered low risk and highly liquid, often used for managing short-term cash needs. Capital market instruments. These have longer maturities and include corporate bonds, government bonds, equities, stocks, mortgage-backed securities. Capital market instruments are used for long-term financing and typically involve more risk than money market instruments, but they can also offer higher returns. The choice between money market and capital market instruments depends on the investor's goals, time horizon, and risk tolerance. 3. Relationship among financial institutions, monetary policy, and economic stability. Financial institutions act as transmission channels for monetary policy. When the central bank changes interest rates, the cost of borrowing for banks changes. Banks then pass these changes along to consumers and businesses, influencing spending and investment. For example, lower interest rates, cheaper borrowing costs stimulate consumption and investment, potentially boosting economic growth. Higher interest rates, more expensive borrowing slows spending and investment, helping to control inflation. Economic stability depends on how well this transmission mechanism works. If banks are weak, perhaps due to high levels of bad loans, they may be reluctant to lend even when rates are low, limiting the effectiveness of monetary policy. Financial institutions also play a role in crisis prevention. Strong regulation and risk management can prevent the kind of reckless lending that leads to asset bubbles and collapses. Conversely, weak oversight can allow excessive speculation, which destabilizes the entire economy. 4. Pricing in financial markets. Pricing in financial markets is determined by the interaction of supply and demand, but it is influenced by expectations about future events. For example, if investors expect interest rates to rise, bond prices typically fall in anticipation. If earnings reports exceed expectations, stock prices may rise as investors anticipate higher future dividends or growth. In highly liquid markets, prices adjust quickly to new information, a concept known as the efficient market hypothesis. However, in reality, markets are not perfectly efficient. Behavioral biases, slow dissemination of information, and unequal access to data can all cause prices to deviate from their true value. 5. Institutional structures of financial markets. Financial markets operate within a framework of institutions, including exchanges, such as the New York Stock Exchange, NYSE, or the Nigerian Stock Exchange, where securities are listed and traded. Over-the-counter, OTC, markets, decentralized markets where participants trade directly with each other. Clearinghouses, institutions that ensure transactions are completed and manage counterparty risk. Regulators, Government agencies or independent bodies that enforce rules to protect investors and ensure fair market operation. Institutional structures vary from country to country, but they all serve the same purpose: to ensure orderly trading, protect investors, and maintain trust in the financial system. 6. The evolution of financial instruments and institutions. Financial innovation is constant. Over the past few decades, we have seen the rise of complex derivatives, the growth of exchange-traded funds, ETFs, the emergence of digital currencies and blockchain technology, the increasing role of algorithmic trading. These innovations can improve efficiency, provide new opportunities, and lower transaction costs. However, they can also introduce new risks. For example, while derivatives can be used to hedge risk, they can also be used to take highly leveraged speculative positions that can amplify losses. Financial institutions must adapt to these changes while regulators work to ensure that new products and practices do not undermine market stability. 7. Analytical and research skills for market understanding. Understanding capital markets requires strong analytical skills. Ability to interpret financial statements. Understanding of economic indicators. Knowledge of valuation techniques. Awareness of risk management strategies. Research skills are equally important. Market participants must be able to gather data, interpret trends, and anticipate changes in regulation, technology, and investor behavior. An analytical approach allows managers and investors to make decisions based not on speculation or instinct alone, but on rigorous analysis supported by data. 8. Preparing for the future of capital markets. The future of capital markets will be shaped by technological advances such as artificial intelligence and blockchain, increasing globalization and integration of markets, growing emphasis on sustainability and environmental, social, and governance (ESG) factors, potential shifts in global monetary policy frameworks. Financial professionals must be prepared to navigate these changes by staying informed, continuously developing their skills, and being adaptable. Capital markets and institutions are dynamic, and those who understand their underlying principles while remaining open to innovation will be best positioned to succeed.